Good morning, everyone. Welcome to Midwest Market Solutions Insider Commentaries. It's Thursday morning. It's March the 23rd. Thanks for joining us here. We're going to look at what's going on today in the headlines and long-term perspectives of marketing. First, export sales out this morning. Corn at 58 million bushels, beans 30.1, and wheat at 20.9. There were no private export sale announcements this morning at 8 o'clock. So beans overnight kind of leading the push lower, and we're right at key support 995. We need to bounce off this area as we've continued to trade between this support area and resistance up around 1008 on the May contract since March 14th. So a close below 995 sets us up for additional weakness going into next week's quarterly stocks and acreage report. Now, a couple of long-term perspective things here. Hightower Group did a monthly conference call that they do for their IBs every month, and this week they talked about corn and soybean ending stocks projections, yield estimates. They used corn yield about 165 bushels per acre, so that's down considerably from last year, but still right about the trend line numbers. The key numbers here is stocks did decrease to 1.728 billion bushels, but they key thing is they have production being left in the dust by demand. Demand is going to far outseed production by over 640 million bushels if we produce an average type crop. So we right now have a very strong demand base. If we threaten the crop at all this year, we should see prices rally sharply. We have a big cushion, but that will be forgotten about very quickly during the growing season. Beans, a little bit different story. I think they used around a 48 bushel yield number there. Ending stocks expected to swell 680 million bushels as they believe exports will slow and that our production will outpace our usage of soybeans, and stocks will increase instead of it as in the corn that they will decrease. So keep that in mind as we go into this marketing year. We need some crop threatening weather, but when we do, we should see some pretty sizable rallies, and those are going to be rallies to sell into. Now in the livestock side of things, we've had sharp rally here in the cash market last couple of weeks, huge rallies in the cattle futures. Remember this market here, April futures holding a $10 discount to the current cash, and with the cash moving up, there's really no place for futures to go but higher. And same thing in the June contracts. Those are deferred, and those are deeply discounted by $20. And when those live cattle contracts go higher, feeders are going to go higher. In fact, feeders have been the upside leader here, putting in some premium into the marketplace. So cash is going higher. It looks like U.S. could get some export business out of the JBS news that we've been talking about the last several days. That looks to open the export markets to the United States. And with the export markets opening up, that sets us up for higher cattle prices. This is the reason why we've not recommended to sell the deeply discounted futures. They're already discounted, and the cash is going to have to come down to match the futures, which doesn't give you any profitability on your hedges, or futures are going to rally to meet the cash, which causes a loss on the hedges, and we don't want our clients in that situation. So if you wanted to be covered, we recommended puts or put call spreads, but certainly not any straight futures hedges until we get the futures and cash to align. So if you have any questions on anything, feel free to contact me or any of our 7 offices around the Midwest. This has been Brian Hoops. Hope you have a great day of trade. Good luck, and let us know if we can help you out in any way. Take care. Have a good day.